Welcome to this morning's panel, and thank you for coming after breakfast for this discussion. My name is Kevin Featherstone from the London School of Economics, and I'll be the moderator for the panel. As you can see, the question is, why is the United States growing faster than Europe, and does Europe need to change? The context, of course, is that the US is recording a higher rate of economic growth than Europe, and we ask the question, why? And then we proceed to consider the implications. The United States and Europe have been pursuing different strategies post-COVID. Are there lessons for Europe to learn from the US experience? Can Europe compete with its current mix of governance, macroeconomic policy, and welfare state systems? There are many questions for us to consider. And I'm delighted that we have three expert speakers to help guide us for this complex topic. Let me briefly introduce Marco Buti. He's the current chair of the prestigious Tommaso Padoa-Schioppa position in the European University Institute in Italy. He's a former Director General of the EU Commission. Gikas Hardouvelis is the current chair of the National Bank of Greece, and of course, a former Minister of National Economy. Greene is a long-standing participant in the Delphi Economic Forum and is currently an external member of the Monetary Policy Committee at the Bank of England. So we have limited time. Megan, I'd like to start with you, if I may. Why is the United States growing faster than Europe, do you think? Is Bidenomics working?
Yeah, thank you. There are a couple of reasons that the U.S. is outperforming the rest of the developed world. The most obvious one is in consumption, actually. The U.S. consumer is relentless, as it turns out, and this has often been the case. That's because U.S. consumers are really happy to spend down their savings. So across the developed world, everybody squirreled away excess savings during the pandemic with all the fiscal measures. Americans uniquely are happy to spend them. And as a result, consumption in the US is over 10% higher than what it was just before the pandemic hit. In the Eurozone, consumption has just about reached where it was before the pandemic. And the UK, actually, consumption hasn't quite reached where it was before the pandemic. So the US is a massive outlier on that front. Consumption, by the way, is about 2/3 of economic growth for developed economies, so that's a big deal. There's a lot of research suggesting that that could be because in the US, people were mailed checks during the pandemic instead of having their wages replaced by furlough schemes, and so people are happier to spend what they view as a total windfall rather than just getting what they were getting before but not having to work for it. So that could be partly why the Americans are spending more. There's a big question about where the savings rate is going to end up for everyone when the dust settles, though. But so far, the U.S. consumer is massively outperforming. And then secondly, you mentioned Bidenomics, and at the heart of Bidenomics is public and private investment. There has been massive legislation over the past couple of years in the U.S. to encourage public and private investment. You've got the CHIPS Act. You've got the IRA, the Inflation Reduction Act, that does absolutely nothing to reduce inflation, in fact, but is a huge spending bill that encourages the private sector to jump in, particularly on the climate change side of things. And then you've got the Infrastructure Act. All three of these things have been much more successful than I had anticipated in encouraging onshoring, and again, in creating incentives for the private sector to jump in and invest as well. So investment, public and private, is a lot higher in the US than it has been in Europe. And that affects the demand side of the economy immediately. With a bit of a lag, it also affects the supply side of the economy. So it should boost productivity growth. What we've already seen is that the US is actually an outlier also in that it's had a mini productivity boom over the past 2 quarters, which we haven't seen in Europe at all. Productivity experts would say you can call it a boom when it's happened for 10 years. So, the data is very nascent. We shouldn't break out the ticker tape and throw a parade just yet. But the US really is an outlier in that productivity growth has expanded so much. A big piece of that is immigration, actually. So the labor supply has increased. That's not a piece of it that the Biden administration is singing from the treetops for political reasons, but is worth keeping in mind with the elections coming up in November, that we might see that immigration reverse depending on who wins the election. That's something to watch out for. If it were to reverse, that would, of course, reduce productivity growth in the US. The second piece could be technological innovation. All the tech companies are based in the US, except for Booking.com, which is Dutch. But the major tech firms are in the US, and so we might be seeing technological innovation feed through into productivity growth a bit sooner in the US than Europe. Again, it's only been 2 quarters, so it's really too early to say. But that means we can have this white-hot economy in the US, but if the supply side is expanded as well, it needn't be inflationary. So the US is in this unique position as a result and is able to grow more dynamically than Europe.
Thank you. Gikas, did Biden simply get it right?
Did Biden? To tell you the truth, I was very surprised 4 years ago when Biden immediately he had this expansionary policy right away when he came to office. So I think one basic reason that the U.S. Is doing better in the last 4 years than Europe is expansionary fiscal policy. And you can see it, I recall from 2019 to 2020, the debt to GDP jacked up by 25 points in the US. Of course, a lot of it is due to the denominator, the fact that the GDP declined. But nevertheless, it went up 25%, whereas in Europe, it went up only by 13%. And the recession in Europe was bigger. So it was all fiscal. And you can also see it in how much the government spends relative to GDP. It really jumped up. It jumped up, I think, by 9 percentage points in the US. And I looked at Europe, it was only 6.5. So fiscal policy is definitely an element there. But there is a second reason which has nothing to do with the US, but has to do with Europe. And this was the invasion of Russia to Ukraine. It really affected the inflow of natural gas. It affected the energy market. And it really caused a bigger trouble to Europe, which, remember, Europe imports half of its energy needs, whereas the U.S. has autarky, and it's even a net exporter. And if you think about it, even China is less dependent on energy than Europe. China is only about 25% of its energy bill comes from abroad. So these two elements, expansionary fiscal policy in the U.S., the energy drag in Europe made, I think, the biggest difference. When it comes to technology that I heard, I think Europe kind of picked up after the pandemic. A lot of, if you look at countries and you compare them, many European countries are on digitalization in better shape than the US. Of course, they don't have these big companies, all these big companies that are, with the big platforms are in the US. But that's a different story.
Okay. Marco, staying on the US and the drivers for growth in the US, how do you respond to what's been said and the success?
Thank you very much. First of all, thanks for the invitation. I very much agree with what has been said, but let me ask the question again. Why is has the US grown faster than Europe? Has it? I mean, if you look at the GDP per capita, actually, you take over the past 25 years, actually Europe has managed to catch up. Believe it or not, from 67% to 72% over this period. Now, far from satisfactory performance, obviously, but I think if you take the raw figures, what has mattered a lot is demography. And that is one big issue. And if you look at the future, I mean, the US is going to grow stronger than, in terms of demographic dynamics than Europe.
But do you think in the last 3, 4, 5 years?
Okay, this is, so I mean, having worked at the Commission for many years, one has, acquired all nationalities and known. So today I feel rather Austrian. Austria, I said, looks with confidence to the past. So if you look at past performance, I don't think we have done all that bad. Now, last 4 years, I think very much, Gikas said it, if you look at Europe, energy crisis, we had a massive negative shock, which was in the US, smaller if not positive. At the same time, if you look, and I think there is the IMF World Economic Outlook coming out these days, they look at TFP, where I think we have a problem in Europe and is serious in shaping the policy agenda, is allocative efficiency. So the issue here is how you improve the shift of resources, both capital and labor, from low-growing firms to high-growing ones. And here, the European social model, which has many good qualities, equity considerations being one of them, prevents to do what the US has done in the past years, in particular during the COVID crisis. There was a massive fall in employment, increase in unemployment, and then a bouncing back. In this bouncing back, it was certainly fiscal a big element, but in this jumping back, there was also reallocation towards high-growing firms. So we had to find the same way in terms of results, but the how must be different in Europe.
Okay. Gikas, then let's move on, as we've already been discussing, for the lessons for Europe from this experience. I saw a figure recently which I thought was quite salutary. It said that 1 hour worked in the United States produces 50% more output than the same hour worked in Italy. For the European Union's biggest countries, that same hour produces 20% less output than in the United States. What are the lessons for Europe?
Okay. You touched on productivity, and I'll come to that. Yeah. When I heard Marco saying that Europe is doing the same as the US, it just depends where you start making the comparison. Yeah, if you go back all the way to the financial crisis, still the US has done a little bit better than Europe. If you go further back and start, perhaps Europe is doing a bit better. So but let me come back to your question. And when we try to compare over the long term, the US with Europe, definitely there is a gap. And the gap is due to clearly population growth that Marco mentioned. Population growth, for example, since the financial crisis in the US is 0.7%, whereas in Europe is almost stagnating, 0.2%. And when we look at real rate of growth, part of it is population growth. It's more people, the economy gets bigger. And then the other items you try to see as to why perhaps productivity is better in the US is you try to look at the environment. We already mentioned somehow the US is more lucky than Europe. It has a lot of natural resources, and it's not oil, it's not only oil and gas, it's minerals, whereas the US is an importer, and that costs a lot. And then we have to look at policy, perhaps, the way governments behave, how effective they are. We're comparing one government where there's one minister of finance or treasury secretary, one central bank governor, whereas in Europe you have so many different countries that they have to somehow agree on a common policy, and that takes time. So Europe is delays in its response, in its policy response, and that has effects when a shock comes. Then we have to examine other things, like if we look at the financial sector, for example. It's not only the real sector, you look at the financial sector, and you compare the financial sector in the US with the one in Europe. Definitely in the US is much more developed. It doesn't depend only on banks. If you look at stock market capitalization is like 3 times bigger as a percent of GDP. It's 3 times bigger than what's in Europe. The same thing with the bond market. If you look at other items like whatever you examine, the US is bigger. So when you have a small financial sector and credit does not flow easily, that means the cost of funding is bigger. That makes growth, is a negative on growth. So, and if we look at, now if we examine productivity, other items that affect productivity, do the Europeans do the right thing to improve productivity? And I looked at research and development and how much Europe is spending versus the US, and again, there is a difference. In the US, 3.5% of GDP goes to innovation, to R&D, whereas in Europe, it's only 2.2% of GDP. And then if you look at the digital infrastructure, Megan already mentioned this, yes, the leaders are in the US, but Europe has caught up, especially after the pandemic. I mentioned it earlier. And there are many countries that are in better shape than the US, like Finland, Denmark, Belgium, Sweden, Netherlands, et cetera, many. But on average, Europe is still a bit behind. Then we have to, okay, we look at the external environment, we look at population growth, the environment. What about the labor market itself? We know that the labor market is more mobile. There's more labor mobility in the US. If you find a job you can easily move from Boston to Chicago or to San Francisco, but it's not so easy to move from Rome to Athens and then to Brussels or Spain somewhere. And you have to deal with, if you're a worker, with different pension systems. You have to worry about your career. You have to deal about language. You have to deal with all kinds of things. So mobility is easier in the US. And also, the labor market itself is more flexible. And more flexible labor market means higher productivity, usually. Now, economists, the other item they have looked and they emphasize lately is institutions. Do you have the right institutions so that you can really, all the forces that promote economic growth can sort of push each other? And there, when we compare institutions, I think the picture is mixed. On things like political stability and absence of violence and terrorism, Europe is doing better than the US. When we look at voice and accountability, and I'm quoting here World Bank indicators, Europe is doing better. And in many other things like government effectiveness, regulatory quality, rule of law, control of corruption, the US is doing a lot better. So overall, when we compare the two areas across the Atlantic, the US is doing better, not a whole lot better. I mean, the difference in rates of growth is about 1 percentage point, not much, but it accumulates over time. And we know that Europe has to do things to catch up.
Thank you very much. Marco, there's a lot of discussion in recent times about Europe's industrial policy and competitiveness. Are there lessons from the US experience for us?
Look, I think, okay, industrial policy is the name of the game right now, good and bad. I think in Europe, and Gikas mentioned several things before on peculiarities of Europe compared to the US. If we pursue the national way to industrial policy, I think we end up in the war, literally. We have, I mean, our biggest potential source of dynamism and growth is the internal market. So if you leave it to industrial policy at the national level via flexibilizing or continuing to reduce constraints on state aid, etc., I think deeper pockets will win. And we know, I mean, we have all seen the data, basically between France and Germany, 80% of the state aids have come from them. So we would imperil, I think, the single market big time. if we go the national way. A different thing is if we go at the European level. And there, I think what one should look at is, okay, let me summarize it, also going a little bit beyond your question on 3 times 2. 3 times 2. Okay, what is relevant for what we are saying right now here is leading technologies, looking at the future. A report by McKinsey or, a few months ago shows that, and this is the first 2, only in 2 out of 10 leading technologies, enabling technology for the future, Europe is well positioned. The other 8, in particular, technologies where size, critical mass matters, Europe is way beyond. So we are doing well on next generation material, I think on clean tech, future clean tech. On the rest, I think we are going. So industrial policy at the European level should aim at correcting that. The second 2%, very quickly, is demography. So here, no, this is not 2%, it's 2 years. So if you look at the past 10 years, 2%, 2 years more of the median age. So demographic crisis with us. And the third is 2% current account surplus. Persistent. I think this shows not the high competitiveness, it shows lack of investment opportunities compared to savings that we produce. We have to correct these 3 tubes.
Thanks very much, Megan. If you think of the European Union, is it learning the right lessons from what you were saying before?
So it might be learning the right lessons. It might just not have the same opportunities for a couple of reasons. First, I will say you're right that the US is a net energy exporter, so it didn't face that terms of trade shock. That terms of trade shock is completely unwound by now, though, so that explains why Europe was growing much more slowly than the US. At this point, though, energy prices are a massive drag on inflation across Europe, so I'm not sure that explains it right now, even though the US is massively outperforming on growth. In terms of lessons, though, I think it really comes down to 2 things. One is productivity growth, which increases potential growth. That is, that heals all economic wounds. And there, Europe has lagged the US since before the global financial crisis. It got much worse during the pandemic, though. So potential growth. Gikas, you mentioned that growth is only about 1 percentage point higher than in the US. That's potential growth. And that means that potential growth is about double in the US what it is in Europe. So I think that's the name of the game, trying to figure out how to boost productivity growth and consequently potential growth is how Europe is going to find some sustainable growth. And the second lesson that I'm not sure Europe can learn is about fiscal policy, Bidenomics, industrial policy. And there, I'm not sure Europe has the same fiscal space that the US has had. Now, some are certainly starting to argue that the US has run out of fiscal space. Public debt to GDP has increased significantly in the US after the past couple of years, as it has in many other countries. But the US has the biggest, most liquid asset class in the world, the treasury market. We saw during the banking troubles just over a year ago that actually, when there's risk, when you're in a risk-on environment, everybody does jump into the treasury market and other US dollar-denominated assets. And related to that, the US has the global reserve currency, and I don't see that changing anytime soon. So yes, at some point, debt to GDP will become a problem in the US, but I don't think we're really close to that. And so consequently, the US can afford to implement all of these policies that involve a lot of public investment to encourage the private sector to come in, and it's done it very successfully. Europe has just reimposed fiscal rules. I don't think there's quite the same space in Europe that the US has on that front.
Thank you, Megan. Marco, then now let's fully focus on Europe and what needs to change. We've already had mention about the economic and social model in Europe. You touched on the need for an EU industrial policy, etc. Let's come on to some of the questions about specific policy adaptation. Many have looked at the Next Generation EU fund and concluded that it's been relatively successful. There was a report for the European Parliament just weeks ago which made that kind of conclusion. that kind of fiscal stimulus has had a positive effect. But we're now into the phase of considering whether this borrowing facility for the Commission should continue, that we should indeed have a true Hamiltonian moment. Lead us there as to what needs to be done, do you think, in terms of fiscal space and a European industrial competitiveness policy?
Yes, look, I mentioned the three twos before. I think basically what we need to do is to address these three areas. Yeah. Okay, one is we cannot, as a large economic area, in the world economy, continue to subtract demand from the rest of the world. And that's what a persistent current account surplus actually does. So we have to find more, let's say, indigenous sources of growth. And there, the agenda, I think, is, and the list is not difficult to do. I mean, there will be a forthcoming report by former Prime Minister Letta, coming.
Yes.
I think this is going to be, giving indications of where to go in the future. I think part of the internal market in the broad sense includes also, and we discussed it before, it was mentioned before, Capital Markets Union. I mean, what we have, if you think about the technologies that we mentioned before, and these dynamic sources of growth, these are all investments which, let's put it like that, are long in ideas and short in collateral. So normal banks are unlikely to finance this type of investment. So we need equity. So we need Capital Markets Union. And there is a lot of talks and very, very little moves on the ground. So this is one element. Second, next generation EU, you mentioned it. I think it has, the picture is still mixed. I think it did extremely well in stabilizing expectations at the beginning when we were really looking into the abyss at the moment of COVID. I think the most important message at the time was a political one. It was not the money. The money started to flow 18 months after. I think the markets, when it comes to the crunch, mass market and investors, they are not looking at clever financial engineering. They are looking at, let's say, political determination. And there, what was shown, it was Europe able to take decisions. So leaders getting together and get their acts together. So I think that was an important message. Now, for the future, what the two lessons from Next Generation EU are the following, in my view. First, we should, post-2026, we should retain the approach. And the approach is performance-based transfers from Europe. So you are helped if you do the right investment and the right reforms. So and I think this should be generalized to the EU budget much beyond Next Generation EU. And this we have the next financial perspectives for the EU budget post-2027. So I think this is something that should be retained.
Sorry, just in parentheses, the performance-based transfers, does that imply very close monitoring?
It implies what we are doing now, indeed, very close monitoring on the part of the EU and the part of the Commission on delivery. So now we have milestones and targets, and actual money from the EU budget and Next Generation EU, they come after you have met the milestones, so intermediate targets and final targets. So that, I think, should be generalized. What should be changed, I think, is to move, again, in line with what I said before for central industrial policy, from something which is nationally based to something that the EU-based. So when we negotiated Next Generation EU, I'd say we because I was on the other side of the fence at the time, I mean, a lot went into national spending. I think the name of the game for the future should be European public goods. So what we can do at the European level together in terms of delivery and financing And if you look at the challenges that we mentioned before, basically almost all of them have a European dimension. So European public goods on the double transition, on competitiveness, etc. These are really the critical mass for tackling this issue in the future.
And just briefly, in terms of the magnitude of the capacity at the European level after the next generation, what kind of...
Look, we are looking, I mean, the Mario Draghi is another, the competitiveness report will come, after June.
We're all waiting for Mario.
All waiting for Mario, rightly so, because I think I'm expecting there will be quite important ideas. And I would hope that will shape the next institutional period.
I thought you were going to give me a figure.
No, the figure, I'm not going to give you the figure, but the 500 billion additional investment per year till 2030, make the calculation and say that, let's say 20% should come from the EU level of that, 80% between national level, both private and public, and you get to the figure. It's not difficult to make the addition.
Thank you. Megan, we're not quite at the Hamiltonian moment, but any responses?
Yeah, I guess I've always thought the next gen EU development was important, but more important the next time there was a crisis. Would it be repeated? Would it be a multi-stage game? And when Russia invaded Ukraine, it was not actually repeated, even though obviously Europe and everyone else needs to undergo a massive energy transition. So I guess I'm a little bit more doubtful. Also, yesterday I think we read the story about fraud potentially in the bidding for next-gen EU funds in Greece. We've heard about it in Italy. I wonder if that might undermine some of the political support among Northern European countries. I hope I'm wrong, Marco, and that you're right, actually. But I guess we won't know until there really is another crisis.
Gikas.
Well, one item, when we compare the US with Europe, we should not forget that Europe has a better social model. This is reflected on higher life expectancy at birth, better distribution of income, universal health insurance. So we Europeans are happy with our social model. What we have to do is become more competitive and grow more. And to do that, I think we need to get bigger as an entity, as an area, more unified, therefore. So I'd like to see the fiscal union that sort of started being pushed more. I see elements of a fiscal union in the common defense policy now that we're no longer free riders on the US. You all mentioned tech. Technology now needs huge investments, and a single country like France or Germany or Italy cannot do it on its own. They need to pull resources together if they want to follow an industrial policy, and especially on technology, and compete with the Chinese and the other countries. So Europe needs to we mentioned the financial sector. It needs to actually create a common financial sector. Even banking union hasn't happened yet. Still, we don't have common deposit insurance. We do need a capital markets union. Marco mentioned it. We've been discussing it for 10 years now, and again we're discussing it, and nothing is happening because of politics. But at some point, this has to be done. We definitely need to push to reduce red tape and bureaucracy. This is huge in Europe. And hopefully, and be successful on what Marco and Megan mentioned, the next generation EU, because this is the first test of a common fiscal policy. We issued bonds, and then we're spending it together. So I hope that Europe is moving in that direction. And Europe also faces major challenges when it comes, the demographics, we said it earlier. We need to have a common immigration policy, for sure. We need to follow, perhaps have a common pension policy. So we need to reduce uncertainty of people. So we need to think of smart ideas of how the countries will have similar economic architectures. Therefore, even though their politicians may be different, they can somehow come closer together. That's the way forward. Otherwise, Europe will be small. Now the big players are spending a lot of money. They're making quick decisions. And remember, look at the financial crisis. In the US, it just took the Treasury Secretary and the Central Bank Governor to decide on saving the financial system. In Europe, we were quarreling and discussing it forever. Always, and Europe does change after a crisis. So now the question is, can we change without waiting the next crisis to shake us up and become more united?
Those of us in the hall can hear the winds outside. I don't know whether the Delphi oracles are questioning the answers being given, but or whether they are more pessimistic than the three speakers here. But we have very little time, and I'd just like to ask one final question for a brief answer from each of you, if I may. From a European, an EU perspective, what would make you optimistic that we can meet the challenges? Very briefly, Megan.
Productivity growth, I guess, would be the quickest answer, but also, you know, a huge increase in defense and spending and the climate transition. So an ability to actually use some common funds to undergo these massive changes that have to happen of a kind of transitional nature.
Gikas.
I worry about the US elections. And
I've asked you to be optimistic, and you're reminding us of...
Well, I would like to see the West united. I mentioned Europe being united. I think the West needs to be more united and face challenges. If we all can do it together, then Europe can grow, etc., etc.
Marco, you are the person to leave us with optimism.
Okay, I was lucky to be the last one, so I could think about it. Because one has to think hard. Now, I think what makes me optimistic, but then I look at the more long-term picture, is that I think we have a social model which, if properly backed by the right thing to do on the growth side, and renewed in terms of the social dimension, I think is more appealing to the rest of the world than any other model that exists. From the cutthroat capitalism of the US to the more autocratic models around the rest of the world. I think we will be eventually on the right side of history.
Please thank our panelists.